Let's get into each one of these assumptions. You need to have a strong, not just what is my assumption, but how did you get to it? What do you believe? So the first assumption we're going to work on is the risk-free rate. The traditional approach is use the 10-year treasury. Not everybody uses the 10-year treasury, but that's the traditional approach. Why not the 1-year treasury? Why not the 5-year treasury? Well, shorter term treasury yields are much more volatile, so your assumptions would be swinging around a whole lot more than you would like. What about the 30-year treasury? We're talking about a very long-term investment with stocks. Why not use this 30-year treasury yield? Well, 30-year treasuries are a unique security. They're purchased by very unique buyers and sellers, and because of that, the 30-year treasury yield can react more to supply and demand forces in that part of the market, which is a very limited part of the market. And in fact, there were several years there where we did not have any 30-year treasuries. The federal government had sold off so much of its, had paid down so much debt that there was just no more 30-year treasuries. The 10-year treasury, it's the only interest rate on Yahoo Finance, and it is the most important interest rate in the world. Maybe LIBOR, maybe the short-term bond rate, but LIBOR is actually going away, so it can't be the most important yield. So 10-year treasury is the most likely, but we have an issue. As I said in the last session, it's only 0.59% right now. So how are we going to handle that? So let me show you. I'm going to put it on pause and bring up an article from Dr. Damodaran and show you how you can walk through that. So in the class notes on page 38, you can just search for the name Damodaran. He's a famous professor in finance, just retired from New York Stern School of Business. He has an argument about the 10-year treasury. It's an old article. I cannot find an updated one. However, this issue he's discussing has come back today. I don't know if he still believes this. I've tried to find an updated version of it, but I just cannot find an updated version of it. But so he's probably got a more recent discussion on this. Anyone finds that, boy, I'd give you some good critical thinking points if you can find a more recent discussion of his or anybody else's discussion. So you might just search what to do with an unusually low risk-free rate. I'm sure other professors have written about it. I should probably this summer do a detailed discussion. We've been here for so long with very low treasury yields. How do we handle that? So he has an article that talks about that. So here it is, Musing on Markets, Why Not So Profound Thoughts About Valuation, Core Finance, and the News of the Day. So his not so profound thoughts, but many people think they're actually quite profound. So you can read through this. I won't read this to you, but here he was talking about the 10-year treasury dropped to 175. And he's talking about the historically low. Well, we've this year have dropped to the all-time low for the 10-year treasury in the entire history of the United States. U.S. Treasury had never been below, well, actually 133 was the new record this year. The U.S. Treasury had never been below 1%. We're now have gotten below 0.5%. So whatever he says in this article, multiply by 7 because it's a much bigger issue today. So he talks about the effect on valuation. He gives you some discussion about it. We're going to talk about this chart as we get into market risk premium. This is an important chart. It might be a chart that you might copy and put to your paper, although it's very, very old, so you may not be able to do that. But and then he talks about the choices. He has what he calls a dysfunctional approach, the pressed approach, the denial approach, the dynamic approach. You can tell from his titles that number 4 is the one he's arguing for. And number 4 is just use whatever today's treasury yield is. That is the opportunity cost. So you can use his arguments. You might quote him in your paper if you're going to use that argument. I used to be in the denial approach, which is to normalize the treasury. The first two did not make any sense to me. You can read through them, but they don't make any sense. But I was in this category. I've now gone to the forward rate approach. He doesn't address that anywhere in his paper, but that does give you one person's argument about why you should just use the current 10-year treasury. Now let's have a little discussion here. This is extremely important. So let's think about the theory here. Theory is very important. You should never use CAPM or any other theory of finance if you don't know what the theory states. So let's think about it. CAPM says that the discount rate for stocks, that is KE, should equal the risk-free rate plus beta times the market risk premium or the equity risk premium. So that's a formula every finance major, in fact probably every business major that has any degree from a reputable university knows that formula just automatically off the top of their head. We know that the market risk premium, using the implied approach, we're going to talk about that next, is going to equal the expected return on stocks minus the risk-free rate. So that's extremely important. This part at the end is extremely important, minus the risk-free rate. So what does that mean? If you use the current 10-year Treasury when it is very low, so that means you're taking the expected returns on stocks and you're subtracting a very low number, that means your market risk premium will be unusually high. Everybody see that? Hopefully unusually high. Right, if you expect stocks to make 7% and you subtract 2%, then your market risk premium is 5. If you subtract 1%, your market risk premium is 6%. So if you use the unusually low 10-year Treasury, you will have an unusually high market risk premium. So why does that matter? Why is that important? Well, look at the formula. The risk-free rate plus the market risk premium is going to give you the expected return on stocks. Can you see that? So hopefully you see that in the notes just by looking at the formula. The formula shows that the expected return on stocks equals the risk-free rate plus the market risk premium. So what does that mean? It means it doesn't matter what the 10-year Treasury is, our expected return on stocks is going to be the same. And that gets back to this article. I wish you could put this, and you might be able to find this chart. If you look, you might find that Devin Darren has updated this chart through 2019. That'd be great to put, but the risk-free rate plus the market risk premium, that's what this is. The blue is the risk-free rate, the red is the market risk premium. You notice that the two together, he has them almost always, let's see if I can blow this up a little bit, they almost always come in about 8%. So his expected return on stocks is not that much different. So the risk-free rate plus the market risk premium gives his expected return on stock. He uses the implied approach, just like I do. So the sum of the two doesn't move much. Well, what do you notice is moving around? Well, as interest rates fall, the market risk premium gets much larger. So what does that mean? So this is the critical thinking part of this. So what does this mean? If your beta is 1, the argument doesn't matter. Because risk-free rate plus the market risk premium gives you your expected return on stocks. And if your beta is 1, that's what you get. You don't care about how much of your expected return on stocks is in the risk-free rate and how much is the market risk premium. If your beta is 1, you're just adding those two together. If you have a defensive company with a low beta, what is this going to do? Well, you have a very large market risk premium but a low beta. It's going to give you high valuations. these stocks are favored. So essentially, if you use Damodaran's approach, you're going to have a very low risk-free rate, a very high market risk premium, which is going to benefit defensive stocks. You're going to over allocate to firms that are defensive, have low betas. If you have a cyclical company with a high beta, you will get very low valuations. These stocks are disadvantaged by a low risk-free rate. So, sorry, I can't type very well. I got all the letters, just not in the right order. So if you have a company whose beta is 1, I still want you to write your paper. You can't say, hey, my company's beta is 1, so I don't have to do anything. No, you still need to write your paper, but just realize at the end of the day, it's not going to matter. You're going to get the exact same answer no matter what approach you use for coming up with your risk-free rate. When it matters is whether you're doing a defensive company or a cyclical company. If you do a defensive company using Damodaran's approach, you're probably going to have a stock that's going to look cheap because all your valuations are going to give you high valuations. If you have a cyclical company, especially if a higher beta, the more the impact. So if you're doing a Ford or a cruise line or an airline with betas that are 1.5 to 2 to even 2.5, depending on the debt level, you will get a valuation that your stock's going to look very overpriced. So just be aware of that. That's why it matters. So that's why it's so important to understand the theory. Theory is important. Why are we doing this? So if you go through all of this and you have this big debate and then your beta is 1, I want you to be aware that you just went through a large, long debate, but for your stock, it will not matter. And I just want you to be aware of that. I'm not asking you to try to get your beta to 1. Not at all. I want you to give me the beta you believe about your company. But even if your beta is 1, I still want you to go through this debate. All right? So there's the Damodaran approach. Or at least it was. I don't know where he is today, but you could certainly look that up and see what he's believing today. All right, so there's the first one. As you read through his article, see his arguments. So his third approach that he kicks out, the denial approach, which is the normalized. So today interest rates are unusually low. What should be a normal real rate of interest? A real rate of interest is whatever the return is, ignoring inflation. Anytime you see the word real, you're looking at what is that interest rate without inflation. There's a couple of ways to figure that out. One is you could look at the history of tip yields. Remember that tips, these are inflation-linked treasuries. Their yield is the real rate of interest. So you could go back historically and maybe take the historical average or median, because we had been at such an unusual level, could be considered the normal real rate. You just take that and add expected inflation. We'll talk about expected inflation here when we talk about the market risk premium, but add expected inflation, that would give you your risk-free rate. So there's one approach. Unfortunately, tips have only been around since 2003, so most of their history is during a time where interest rates are low. So if you go in to Google and type H15, the first thing that comes up to me is the Federal Reserve, the St. Louis Fed, And they have all these interest rates. You can see the most current ones up through April 2nd. And if you go down, the inflation linked at the bottom, you notice they're all negative right now. So right now, the real rate of interest in the United States is actually a negative interest rate. So you don't want to use a negative real rate. That's one reason why I think Damodaran may be changing his opinion. I'd be curious if any of y'all find anything that he's currently saying. So you can see the 10-year Treasuries was at, it's below 6.6% now, but as of April 2nd, I think that's last Thursday. Last Thursday it was 0.63%, and the interest rate, the real interest rate, was negative. If you got the historical tips and maybe looked at the average or the median of the 10-year yield, it wouldn't be negative. It would probably be somewhere in the 0.5 to 1% range. Let's say it's 1% has been the median, so 50% of the time it was 1% or higher, and 50% of the time it was below 1%. You take 1% and say your inflation assumption is 2%, so you come up with a risk-free rate about 3% as your normalized rate. That is one approach, and if you look at some of my other videos, that is the approach that I took. So that's one approach. The other approach is just look at, this is my theory, so you got a sweet theory, and that is the real rate of interest should follow U.S. economic growth. And my theory is, if someone buys a 10-year Treasury, it's very, very low risk. They should share some in economic growth, but they shouldn't get 100% of that economic growth because they're low risk. So if our economy grows at 3% on a real basis, then maybe they should get 1 or 2% of that. If our economy grows at 4%, maybe they get 2 or 3% of that. So something of economic growth minus some spread, because the rest of all the risk-taking people should get the rest of that growth in the economy. And so I have a graph that you can see. So see Professor Sweet graph. I'll show it to you right now. It's in Blackboard under Files for Papers, and it's the second to last file. And so if you look in, it's called Mark and Equal Data Support under Papers 3 and 4. And if you look at that, the very last graph in that shows the 10-year Treasury and GDP. Now this is nominal. Nominal is fine because inflation is inflation. So inflation washes itself out. So if we took inflation out of all of this, we would end up with reals, and that would be just a constant subtract from both of these. So it doesn't matter. But what I'm trying to look at is the spread between 10-year Treasuries and economic growth. So the whatever that color is, gold line is economic growth in the U.S. on a nominal basis, but that's fine. The 10-year Treasury nominal, but what is that spread? And you can see my debate that people who buy Treasuries should not get the full return in the economy worked really well from the 50s through the mid-80s. Our economy grew quite a bit more, about 2%, 2 to 3% more than what we got in 10-year Treasuries. So if you bought 10-year Treasuries, you would essentially get the economy minus maybe 2%. Unfortunately, my theory has not worked since the mid-80s. As you can see, the 10-year Treasuries have been a little bit higher and even right in line with economic growth. Now, I haven't updated this in a couple years. I really need to. The problem has been economic growth comes out so slowly. I doubt if it would have a big impact, except for, probably if I go to the end of 2020, given how low interest rates are right now, my guess is we're definitely well below. We're in this lower range. So the last couple years, my argument works. The economy's grown about 3.5%, and interest rates have been about 2.5%. So that's a possible assumption. So that difference, I'm going to say, maybe supports Treasuries at expected GDP growth minus, say, 1%, maybe. Well, 1 to maybe 2%, maybe. Interest rates are so low right now, I'm not really sure where in that range. So if you do that, then you can take what we will do for the market risk premium where we're going to come up with an expected economic growth and use that minus whatever spread you want to use, 1 or 2%, to be your risk-free rate assumption. All right, so I'm going to stop there. So that's one approach that you could use. The last one is the forward rate. What I'll do on the forward rate is when I save this document, I'm just going to give you some YouTubes. Next session, I'm going to and probably be the next class, because last week we had an online live session that went about 30 minutes. So I want to count that as part of our class time. I don't want to have our videos where I actually get extra time. I don't want to do classes that are more than 75 minutes. So I'm going to stop here. In next class, what I'll do is I'll talk about the theory of the forward rate, but then I'll give you YouTubes that allow you to do the actual math you want to do that approach. I do like this approach better just because I think it seems ridiculous to use a 0.59% risk-free rate. Normalize, as we've been so abnormal for about a decade or more that it's hard for me to say we're going to go back to some normal level. So let me use the forward curve. The forward curve will get us back to, here I'm going to say, the new normal, and maybe that's an approach that makes some sense. So next class we'll start there, and I'll teach you a really cool thing to do, which is the forward rate.